In this video, we will talk about the long-term liabilities in QuickBooks and also look at the detail types. Think of long-term liabilities as the money your business owes that you don't have to pay back for at least a year. It's like having a car loan or mortgage. You're not expected to pay it back tomorrow, but you still owe the money. In QuickBooks, these are debts that appear on your company's books as obligations you'll eventually need to pay, just not within the next 12 months or 1 year. If we talk about the detail type, we have just three types here. First, we have the notes payable, and this is a formal IOU where your business borrowed money and signed an official document promising to pay it back within whatever time limit with interest. If I were to give you a real world example, let's say you borrowed $50,000 from a bank to buy new equipment for your bakery with a 5 year repayment plan. In that case, you will add them right here. Similarly, let's say you have a $100,000 business loan to expand to a second location. You can also add them right here. So all the loans that needs to be repaid after 12 months, you can add them right here. So when you record a note payable, you are tracking both the money you received, which helped your business, and the obligations to pay it back. Each month, part of your repayment reduces this liability. So the use case for this will be equipment financing, business expansion loans, commercial vehicle loans, working capital loans from banks, and so on. The next detail type is the other long term liabilities, and this is the miscellaneous drawer for long term debts that you don't fit into specific categories. It's any money you owe long term that isn't formal loan or note. If I were to give you a real world example, let's say you negotiated a 6 months of free rent, but you'll need to pay it back through higher rent in next 2 to 5 years. You can add that right here. Similarly, let's say you are leasing a $200,000 printing press for next 7 to 8 years. You can add that here as well. Or let's say your business agreed to pay $60,000 over 3 years to settle a legal dispute. You can also add that right here. You can also add bonus here, long term bonus. Like, let's say you promised your sales manager a $25,000 bonus payable in 2 years if they stay with the company. You can also add that right here. So these are recorded when you have a long term obligation that does not fit in a traditional setting, that does not involve a traditional loan document, right? So you still owe the money, but the arrangement might be more unique or complex. So the use case would be long term warranty obligations, environmental cleanup responsibilities, pensions obligations, customer deposits for projects that starts next year. You can add them right here. Finally, you have the shareholder notes payable, and this is the money your business borrowed from its owners or shareholders with a formal agreement paid back. So, for example, let's say you personally loaned your own company $40,000 to get it started with plans to pay it back yourself um, over 5 years. Or let's say a shareholder with 30% stakes in your company loans the company $200,000 for expansion instead of diluting their ownership by bringing in new investor. You can add that right here. Even though the owner and the business might feel like the same thing to you, legally they are separate. When an owner loans the money to their company, it needs to be tracked formally. This shows the business owes the owner money just like it would owe a bank. So these were the detail type. Now, the reason why these categories matter is because the IRS wants to know who you owe money to and why. Shareholders' loans are treated differently than the bank loans. For financial health, these are crucial as well. So, banks and investors look at these to understand your debt obligations. Too much long term debts can make it hard to get new loans. Similarly, this is also crucial for planning, like knowing when large debt come due helps you plan the cash flow. If a $50,000 note becomes due in 18 months, you need to start preparing right now. And this is also important for accuracy as well. A quick tip related to this: always keep the documentation for any long term liabilities, all your loan agreements, uh, promissory notes, contracts, and so on. You should review these accounts quarterly to ensure you are tracking payments correctly and work with your accountant to properly classify borderline items. So, yeah, these were the long term liabilities in QuickBooks. I hope you learned something. Thanks for watching.